Welcome to Share Talk. Today I have the pleasure of speaking with Karl Smithson, who is the CEO of STEL Diamonds. How are you today, sir?
Yeah, I'm very fine. Thank you, Stephen.
Well, the London-listed diamond company, of which you're the CEO, focused in the West African region, you've recently completed a placing for over £300,000, which has lifted you out of suspension. Could you give us a brief overview of what's been going on there, please?
Yeah, sure. We were suspended because we were undertaking a reverse takeover of what was deemed a larger asset in Sierra Leone. We hold an asset called Tongo, and there's a neighbouring asset called Tonguma. And between the two of these, it covers basically the whole of the very rich Tongo diamond fields in that country. So we agreed a deal with the owner of that Tonguma license, but the stock exchange deemed it a reverse takeover. So we were suspended when we announced this in August. So since that time, we've done a lot of work actually, leading towards what we would have hoped would have been the completion of the RTO. That would include the mine plan for the combined resource, the resource statements for both properties, the CPR, very detailed financial model, a lot of legal due diligence work, etc., etc. But it got to the end of last year, and we discussed with the other party another way of doing the transaction as opposed to an acquisition and a reverse takeover, which would kind of make things a little bit easier. And we agreed to agree on a new structure. And so, a few weeks ago, we announced that we raised a bit of money, which allowed us to get back trading on the stock exchange. We are still doing a transaction, but it's just under a different kind of structure. So, the deal's still going ahead.
So, in regards, obviously, to the project, I note from the RNS dated the 27th of February that you've actually put a potential for an estimated after-tax NPV of about 104 million US dollars. Could you talk to us how that's come about, please?
Yeah, sure. Well, it's based on all of what we've done so far, which has been independently done and signed off. I'm talking now the resource statement and the mine plan. So we basically took that information and with the consultants prepared the financial model. And it came to this 104 million, which you mentioned, which is currently many multiples of our current market cap. But that model basically encompasses a mine plan over 21 years, mining just in an initial 4.5 million carats of resource for that period in time. It does not include any of the other carats that we target for resource on both properties, and those we estimate independently has been estimated at 8 million carats in addition. But the NPV that we announced does not include those 8 million carats, and I think that's future upside that people need to be aware of. So we ran the model. The consultants ran the model on a pre-tax level. We then, with our financial advisor Mirabeau, took that to a post-tax level, which took into various considerations of the fiscal and legislation regimes in Sierra Leone, and also some assumptions there on forward diamond pricing. So basically, it's a very detailed model, pretty robust and backed up by independent consultants. So, it is a very tangible model.
Karl, in relation to the differentials between a normal mine, for instance, for copper and gold, where you can actually work out the resource in place, not a lot of people understand how you do that with a diamond mine. Could you talk to us about that process and thus how you've obviously enabled the company to have that NPV amount in place?
Yeah, sure. Look, I mean, we've got a resource in place already for this. This has been independently signed off, and this resource model is on the basis of a combined spend so far of $44 million on the properties. So, a lot of work's been done here, a lot of drilling, a lot of bulk sampling. So we have, high levels of confidence in the resource in the ground. And then clearly it's a matter of taking that resource and building a mine plan around that, what production levels you can support, what the cost of that production is going to be, and what the sales value is likely to be going forward. So all of that was taken into consideration. A very detailed financial model has been the outcome of that, and we've applied various sensitivities analysis to that. Giving it, hitting it hard basically with, what if your project costs run over by 25%, or if your diamond revenue is lower by 25%, etc., etc. And the model stands up. So we've got good confidence in the financial model and the mine plan.
So looking forward for the financial model and the mine plan then, could you tell us first and foremost about the proposed tribute agreement and what that would mean for the company and us, the shareholders?
Yeah, well, this is the new structure that I alluded to earlier. Tribute mining is kind of a known thing whereby, we will contract mine the adjacent property. So what we intend to do is what we've always intended to do is build our mine on Tongo. But instead of acquiring the adjacent property, we'll use our existing infrastructure once our mine's up and running, and then we will use that footprint and infrastructure to mine what we have next door on the Tonguma concession. So we retain full ownership of our license, the partners retain full ownership of theirs, but we have rights to mine that project and that resource that sits on that property in perpetuity, effectively, and the rights to extract those diamonds and sell those diamonds. And what we would then do is we would pay back a revenue share for that privilege, if you like, of 10%. There's a bullet payment 5 years from mine development on top of that. But the good thing about this kind of structure is that there is no acquisition cost to Stellar. We don't pay $1 to take that right to mine those diamonds going forward. All we do is we invest into the development of our project and obviously what goes into the ground on the other project. But part of the agreement is that we recoup that money first before we then start paying a revenue share out. So we see this as it's a good structure for Stellar, and it's it's fairly, I can't say low risk in terms of the financial risk, but we get our money out before we start paying a royalty. So I think that's a very positive thing for Stellar to have.
So looking forward to the mining plan then, what are the next steps for the company?
Yeah, well, over the next 2 to 3 weeks, we're going to be concluding the two agreements that we're putting in place for this structure, and that's going to be basically the revenue share and the operating agreement. We will be full operators of the project, so those are well advanced, and we'll be signing those off hopefully in the not too distant future. There's a bit of legal work that we're just going to complete. And then the key is, we're going to raise the first tranche of funding to develop this mine. We're in discussions with a strategic investor. We'll talk to shareholders and we'll talk to institutions as well when the time comes, and hopefully be able to secure the necessary funding to get this mine up and running.
Is there anything further that you would like to add there, Karl?
Well, I think, you look at our market cap and you look at the value of the project. I think the market is obviously not appreciating the value proposition here. And, my take on that is, I think you pointed out earlier that diamonds is not for everyone, of course. But, if you get the right project at the right time, they can be very, very lucrative. And, I think it's for us to sort of better communicate that message across that this is going to be a game changer for Stellar.
What sort of timescale would you put on to sort of production and first sales if everything goes according to plan?
If everything goes according to plan, we'll be in production within 12 months. We feel very confident of that because of the amount of spend that's been made on the projects, the infrastructure that's already there, the processing plant that is already there, and the nature of the resource. We could get into production within the 12-month period, and then it's basically a ramp up to full production. But it ramps up actually very quickly, and so by the second year, for example, we'd be producing well over 100,000 carats. In the third year, almost 200,000 carats per year. And when you're talking values of $200 to $300 per carat, I think the numbers speak for themselves.
Karl, it's been a pleasure talking to you, and I look forward to following the story around Stellar Diamonds in the future.
My pleasure. Thank you, Stephen.
Thank you for your time.